If you are a regular viewer of financial content on YouTube, you may have noticed a sharp decline in content quality within this genre, especially from the top creators. Many others, including myself, feel the same way. I've been watching financial content for a long time. Back in the old days, there was sensible, educational, and well-crafted financial content that helped people make better financial decisions. Nowadays, it's all about scary titles and flashy thumbnails, with every other video predicting an economic doomsday. People are disappointed not only about the decline in content quality, but also about deeper issues ranging from giving bad financial advice all the way to promoting scams and not taking any responsibility for it. Which makes me wonder how on earth those once admired for their simplicity, honesty, and dedication to sharing valuable financial knowledge transformed into greedy and corny salesmen focused solely on exploiting their audience for personal gain. Welcome to the episode of What Went Wrong with Finfluencers. You might recognize this face. He is Sam Bankman-Fried, the CEO of FTX. FTX was a crypto exchange that turned out to be a scam, costing billions of dollars to investors, users, and causing a significant loss of respect and credibility for finfluencers. FTX raised to popularity pretty quickly after being founded in 2019. Its meteoric rise was fueled by an aggressive marketing strategy. The company spent over $1 billion on celebrity endorsements and sponsorships, crafting an image of innovation and trustworthiness. The portrayal of Sam Bankman-Fried as the most generous billionaire who is down-to-earth, visionary, wears simple clothes, drives a Toyota Corolla, and has pledged to donate his entire fortune was a part of this campaign. While this image was effective in fooling investors, it alone was not sufficient to account for FTX's exponential rise. So they partnered with celebrities, sponsored high-profile events, and most notably, collaborated with finfluencers, the most trusted voices of finance advice on YouTube and other social media platforms. FTX poured millions into these creators, not for one or two promotions, but for relentless campaigns that turned this company into a $32 billion crypto giant. Everything seemed picture perfect. FTX was growing at an unprecedented pace, creators were cashing in on lucrative sponsorship deals, and Sam Bankman-Fried was getting all the attention he wanted. Magazine covers hailed him as the face of crypto, the genius who could do no wrong. His image was so meticulously curated that he was considered the poster boy of the entire crypto industry, perpetuating the illusion of success until it all came crashing down. In November of 2022, a report from CoinDesk revealed troubling details about Alameda Research, a trading firm closely linked to FTX and also owned by Bankman-Fried. The report indicated that Alameda's balance sheet was heavily reliant on FTX's native token, FTT, raising serious concerns about the firm's financial stability. This revelation triggered panic among investors and customers, leading to a surge in withdrawal requests from FTX, which it obviously couldn't process. Soon, it became clear that FTX wasn't what it seemed. It was a scam that left many people's money and trust in ruins. Customers lost around $8 billion, and many of them had trusted their favorite influencers who had enthusiastically endorsed FTX. When this happened, viewers felt betrayed by the very people they admired and turned their frustration towards these influencers, accusing them of promoting a fraudulent platform. However, influencers argued they were unaware of the underlying fraud. After all, they only had access to the information available to the public. Creators like Graham Stephan uploaded videos sharing their side of the story, but people weren't buying it anymore. Because this wasn't a movie. If you didn't like, you could just leave a 1-star review and go on about your life. This is finance, a subject that profoundly impacts people's lives. So there was no easy escape for these influencers. Just to peek at their comment section will give you an idea of how frustrated people were. One user wrote that felt like a statement written by a PR firm, but with 41 million subscribers. Same old wine, brand new bottle. And the video is filled with comments like this. Now, the growing anger against finfluencers is not just tied to one isolated incident. This has happened on multiple occasions. For instance, some finfluencers endorsed Voyager and Celcius, both of which eventually filed for bankruptcy. More recently, there's been a controversy surrounding Yotta Bank. promoted by Graham Stephan and some other influencers, where users are now struggling to withdraw their funds. Although they may not have done this intentionally, but bad promotions isn't the only issue that has cast finfluencers in a negative light. When most finfluencers started creating content, the finance niche had little credible information available. The dominant voices in the finance page were figures like Tai Lopez, who didn't provide actual financial advice, but instead sold courses based on hollow promises of a rich lifestyle. Their strategy relied heavily on showing luxury, women, cars, mansions, exotic travels to lure people in. Those who fell for these deceptive tactics realized too late that they have been scammed. This created a significant void in the finance space. People were tired of these characters and eager to learn how to manage their money better. Finfluencers stepped in to fill that gap, providing simple and valuable content that genuinely helped their audience. Over time, it helped them build their credibility as financial experts and establish their personal brands. Fast forward to 2020, when the pandemic hit, the world came to a standstill, and financial hardships became a harsh reality for many. This made people realize the importance of saving and investing, leading to a growing interest in personal finance. Finfluencers were quick to capitalize on this opportunity, producing more videos to meet the inflated demand. However, there are many niches on YouTube that have a content limitation, and finance is one of them. This means there's only so much valuable, informative, and engaging financial content one can create. After all, in how many ways can you explain the benefits of investing in index funds? Additionally, in the YouTube game, viewership plays a crucial role in determining how much a creator earns. A decline in viewership leads to decrease in both YouTube revenue and sponsorship rates, resulting in an overall drop in creators' income. And finance channels often struggle with maintaining consistent views. To tackle these challenges, some finance creators started doing things that ultimately hurt their image as financial experts. For example, they started creating the same type of videos with fear-mongering titles and clickbait thumbnails, which helped them maintain consistent viewership. Because fear-mongering thumbnails in general tend to get more clicks. Now, if the content is genuinely valuable, a little clickbait is fine. But finfluencers like Graham Stephan have shifted towards creating videos on trending topics by simply reading news headlines. His content nowadays often boils down to picking a trending topic, presenting one viewpoint, then the opposing viewpoint, followed by a generic and repetitive opinion on the topic. This approach strays far from the perception of a financial expert. Not only that, but he frequently creates repetitive videos around the same topics. For instance, during my research, I noticed that Graham's channel features at least one video every month about Fed rate changes, simply because it's in the news at least once a month. The issue is that the impact of Fed rate changes can be thoroughly explained in one or two videos at most. There's no need to churn out videos with scary titles and clickbait thumbnails every time there's some news. This becomes especially concerning when considering that a survey found over 1 in 3 Americans are not financially literate. Many people have limited knowledge of finance and watch these videos hoping to make better financial decisions. However, this can be dangerous, as it may create a false sense of financial literacy, leading to poor financial decisions. The other thing many finfluencers started doing is they started creating videos about the stock market and cryptocurrencies, often recommending a particular stock or crypto. This wouldn't be an issue if people were genuinely profiting from these recommendations. However, many of the stock picks suggested by these finfluencers have turned out to be disastrous. For example, a YouTube channel named Financial Education uploaded a video on May 28, 2021. The title of the video was "This stock is the next 5x," and the stock he was talking about was Voyager Digital, a crypto trading platform. At the time of the video, the stock was surging, but just 1 year later, the company filed for bankruptcy, leaving the stock worthless. Similarly, another channel, Stock Mo, uploaded a video on January 21st, 2021, recommending 3 stocks: NEO, CRISPR Therapeutics, and Tattooed Chef, all at their peaks. Today, those stocks are down significantly. NEO minus 93%, CRSP minus 81%, and Tattooed Chef minus 98%. These are just a few examples, but there are many similar cases. And no matter how experienced or knowledgeable someone is, it's impossible to consistently predict whether a stock will go up or down. A stock could rise in 3 months or fail to generate profits over a lifetime, and finfluencers are well aware of this uncertainty. Yet, they continue to make stock recommendations. What makes it worse is that some of these creators are selling stock market courses, which raises a valid question. Should someone whose stock recommendations have performed so poorly be selling courses at all? Now, there are some other influencers who don't sell courses or recommend stocks, but instead share their investment portfolios. And honestly, there's nothing wrong with that. However, they need to understand that many people don't see them as regular folks like you and me. They are often viewed as experts, so many people tend to believe whatever they say. But the truth is, these creators are not financial experts. They are just good communicators. Most of them got popular by explaining simple financial concepts. For example, Graham Stephan, who has the biggest finance channel on YouTube, was a real estate agent, so it would make sense for him to make videos about real estate. Similarly, Andrei Jikh, the second biggest finance YouTuber, was a magician, so teaching magic tricks would align with his expertise. Now, there's nothing wrong with giving financial advice without a formal financial background. In fact, it would be amazing if these influencers were sharing advice based on wealth they had built primarily through stock investing or by following the same strategies they recommend. But that's not the case. Most of them made their money from content creation and then invested that money in stocks and other assets. So the real lesson to learn from them is how to create content so that people see you as an expert even if you're not. A report by Dutch regulator AFM looked at 150 influencers and found that none were licensed to provide investment advice. Most of them didn't have a financial degree or any relevant experience in the field. Now, to be fair, you don't need a degree to give good financial advice. But if you're influencing so many people, you need to think about the impact your advice can have. The reality is, it takes a lot of discipline and money to succeed in the stock market or achieve financial freedom, and most people don't have that. Plus, if something goes wrong, these influencers usually have enough assets, businesses, or savings to handle the loss. Their audience, however, doesn't. Most people watching them don't even have 3 to 6 months worth of savings to fall back on. This is why influencers need to think carefully before giving financial advice. When they don't, it's no surprise that people feel disappointed or even betrayed. Recently, many small YouTube channels have been exposing major financial influencers and addressing the issues surrounding their practices. What's surprising is how their audience is reacting. Usually, when a small channel creates a negative video about a big YouTuber, the audience of the big YouTuber comes out in support of their favorite creator and starts commenting against these small channels, accusing them of clout chasing. However, this time it's completely opposite. People are praising small creators for speaking up. Some folks in the comments are even saying they have stopped watching influencers altogether. And honestly, why wouldn't they? I mean, from a neutral perspective, it's like watching the same old scam being repeated over and over again. It reminds me of the whole meme coin fiasco that has been going on for a while now. The steps to a meme coin scam starts with becoming a viral meme, getting famous, and then using that fame to start a meme coin, make crazy money out of it, and then just disappear. These influencers kind of followed the same template. At first, they gave out genuine solid advice and built trust, but then they started cashing in on their brand value, taking massive sponsorship deals without doing proper due diligence. It's like they traded their credibility for a quick payday, and now people are calling them out. To be fair, not all products they promote or advices they give are bad. Analyzing 110 search results for beginner information across YouTube, TikTok, and Instagram, a CFA report found that influencers commonly promote good practices like building an emergency fund, paying off high-interest debt before investing, warning viewers about the risks of stock picking, and promoting sound investment principles like diversification and long-term investing. They also often focus on promoting index investing and ETFs, which, while only one style of investing, are generally considered cheap and well diversified, making them a more appropriate approach for beginners. This clearly shows that influencers can be a force for good, and in many instances have had a positive impact on their viewers. So we can't always blame influencers for everything that's wrong in the finance community. There's responsibility to be taken by the audience as well. The main problem is that many people watching these influencers are chasing the next Tesla or Bitcoin. Instead of diversifying and investing wisely, they go all in on one stock and end up losing everything. They're chasing quick wealth because most people think that it's not worth becoming rich in older ages. And I get it. I used to think the same way. I wondered, what will I even do with the money if I get it at 65? But here's the thing. Let's say you didn't have the chance to get fancy toys or visit Disneyland as a child. Do you regret it every day now that you're an adult? Probably not. Similarly, at 65, most of the things that you think matter now won't matter then. But if you're rich, you'll have the financial means to enjoy the things that truly do matter at that stage of your life. True wealth isn't about material possessions, it's about security, freedom, and the ability to live life on your terms. So it's not about how old you are when you become rich, but whether you become rich at all. If you operate with a scarcity mindset and lack patience, it doesn't matter which influencers you listen to or whose advice you follow. It will be difficult to achieve anything significant in life or feel true happiness and satisfaction. So I'll end this video with a quote from Napoleon Hill that goes, "Patience, persistence, and perspiration make an unbeatable combination for success." If you like this video, subscribe for more, and thanks for watching this one.